The intrinsic relationship between entrepreneurs and companies is the dynamic core of every modern economic system. This symbiotic interaction is the driving force that generates value, innovation, and employment within the market. Understanding the nature of this connection is essential for every economic operator. The entrepreneur emerges as the central and driving force of this complex system. He or she takes the initiative, catalyzes resources, and directs strategies, determining the direction and success of the enterprise. Their vision and decision making ability are irreplaceable. The entrepreneur's primary role is the methodical organization of economic activity. This involves structuring human, material, and financial resources into a cohesive and functional system. Organizational efficiency is a prerequisite for sustainability and growth. At the same time, the entrepreneur is responsible for the strategic and operational direction of the business. He or she defines objectives, implements policies, and monitors performance, constantly adapting the business to changing market conditions. Leadership is a crucial aspect of this role. A distinctive and unavoidable element of entrepreneurship is the assumption of business risk. Entrepreneurs expose themselves to market uncertainties, investing capital and resources with the prospect of profit, but also with the possibility of losses. This propensity for risk is intrinsic to the nature of the business. A business, for its part, can be defined as an organized complex of assets and resources. These elements, which can be tangible or intangible, are coordinated by the entrepreneur to achieve specific production or commercial goals. Their synergy is essential. The fundamental purpose of a company is to produce goods or provide services for the market. Through this activity, the company satisfies the needs and desires of consumers, contributing to collective well being and the circulation of wealth. Value creation is its primary objective. Ultimately, a company's primary economic objective is profit generation. Profit represents the entrepreneur's return on invested capital and risk and is also the lifeblood of reinvestment and business expansion. Profitability ensures business continuity. The legal definition of an entrepreneur is enshrined in Article 2082 of the Italian Civil Code. This fundamental provision establishes the objective criteria that qualify an individual as an entrepreneur, distinguishing them from other professional figures or occasional activities. Its interpretation is crucial to the application of the regulation. The first essential requirement is the professional practice of the business. This implies that the activity must not be episodic or sporadic, but carried out regularly and systematically. Professionalism denotes a consistent and organized dedication to the business. The specification of continuous and not occasional activity reinforces the concept of professionalism. The entrepreneur operates with a long term perspective, planning their actions over time and maintaining a stable operational structure. Occasionality precludes the entrepreneurial qualification. The second requirement is that the activity be economical. This means that the activity must be oriented towards the production or exchange of goods or services, with the aim of covering production costs and ideally generating a surplus. Economicity is a guiding principle. The specification, profit oriented, further clarifies the economic nature of the activity. While it's not always necessary for a profit to actually be made, the intent to make it must be present. The absence of such a purpose may disqualify the activity from being classified. The third requirement is that the business be organized. The entrepreneur must coordinate and systematically employ production factors such as capital, labor, and resources. Organization is the supporting structure that allows the business to function efficiently. This organization involves the use of human resources, that is, the collaboration of employees or self employed workers. Personnel management is a fundamental aspect of business activity requiring specific skills in selection and motivation. Furthermore, organized activity requires the use of material resources such as machinery, equipment, buildings, and raw materials. The proper management and allocation of these assets are essential for production and distribution. Efficient use of resources is crucial. The fourth requirement is the purpose of producing goods or services. The entrepreneur creates value by transforming inputs into outputs that satisfy market needs. This productive function is the basis of every economic activity. Finally, the fifth requirement is the purpose of exchanging goods or services. The products or services produced must be intended for the market, that is, offered to third parties in exchange for consideration. Exchange is the moment when the value created becomes financially tangible. Commercial entrepreneurs are subject to specific and more stringent legal regulations than agricultural entrepreneurs or small business owners. This regulatory differentiation reflects the greater complexity and broader economic impact of commercial activities. Knowledge of these obligations is essential. One of the fundamental obligations of a commercial entrepreneur is registration in the company register. This register, maintained by the Chambers of Commerce, is a legal publicity tool that ensures transparency and certainty in commercial transactions. The business register is a public register that provides detailed information on business activities. It contains company details, its registered office, corporate purpose, powers of representation, and other information relevant to third parties. It documents the company's incorporation, any amendments to its bylaws, transfers of registered office, appointments of directors, and any other significant events that affect its structure or operations. Timely updates are essential. Registration in the company register is essential for legally disclosing the company's documents and facts. This means that the information contained therein is considered publicly available, even if not actually known, producing binding legal effects. This legal disclosure is essential for the protection of third parties who engage in business relationships. They can rely on the recorded information to assess the reliability and legitimacy of the business operator. Transparency reduces transaction risks. Another crucial obligation for business owners is maintaining accounting records. These systematic records document all of the business's economic and financial transactions, providing a clear picture of its management. Typical examples of mandatory accounting records include the general ledger, which chronologically records all company transactions. This tool is essential for reconstructing the company's financial history and verifying its accuracy. Another example is the inventory book, which lists and evaluates all the company's assets and receivables, as well as its liabilities. The inventory provides a snapshot of the company's assets at a given point in time, usually at the end of the financial year. Accounting records document a company's economic activity in an analytical and systematic manner. They form the basis for preparing financial statements and analyzing company performance. Their accuracy is of paramount importance. They allow for constant monitoring of the company's financial situation, i.e., the composition and value of its assets. This monitoring is vital for strategic planning and assessing financial strength. They also allow for monitoring the financial situation, i.e., the company's ability to generate cash flow and meet its payment obligations. Careful financial management is essential for survival. Finally, maintaining accounting records is essential for fulfilling tax obligations. These records are used to calculate taxes due and file tax returns, ensuring compliance with tax regulations. The legal definition of a business, pursuant to Article 25555 of the Civil Code, identifies it as the complex of assets organized by the entrepreneur for the operation of the business. This formulation emphasizes the unitary and functional nature of the business complex. The importance of asset organization lies in the fact that they are not considered individually, but as a coordinated and purposeful whole. Their interconnection and synergy create value greater than the sum of its parts. Equally crucial is the importance of the asset's purpose for business. It is this functional purpose that gives assets their business status, distinguishing them from merely personal assets or assets not instrumental to the business. The transfer of a business is a highly complex legal process. It's not simply the transfer of individual assets, but the transfer of an organized economic entity with all its relationships and goodwill. There are various ways to transfer a business. Sale is the most common form, with ownership transferred in exchange for a price. This process requires a careful assessment of the company's value. Another option is business leasing, where the entrepreneur grants a third-party use of the business for a fixed period while retaining ownership. Leasing allows for temporary management without divestment. Business donation, although less common, is another option, often used in family contexts for generational transitions. It involves a free transfer with specific tax and inheritance implications. The implications of the transfer include the transfer of ownership of company assets, both tangible and intangible. This includes real estate, machinery, inventory, as well as patents, trademarks, and licenses. Often, a business transfer also includes know-how, that is, the sum of the technical knowledge, skills, and experience accumulated by the company. This intellectual property represents significant added value. In many cases, the transfer of a business includes the customer base, i.e., the established client portfolio and existing business relationships. Customer continuity is essential for maintaining the value of the goodwill. The use of distinctive signs is strategic for every business, as it allows it to stand out from the competition and communicate effectively with the market. They are identification and positioning tools essential for building a corporate image. The company name is the name under which an entrepreneur conducts business and identifies themselves in commercial transactions. It may be the same as the entrepreneur's civil name or a fictitious name, but it must be distinctive. The sign is the visible sign that distinguishes the premises where the business operates. It serves a localizing and attracting function, guiding customers to the physical location of the business. Its visibility is crucial. A trademark is the distinctive sign of a company's products or services. It may consist of words, designs, shapes, sounds, or combinations thereof, and serves to identify the commercial origin of the goods or services. Protecting trademarks is crucial for safeguarding a company's image. A well protected trademark prevents third parties from unduly exploiting the company's reputation and recognition. This protection is equally essential for protecting a company's reputation, which is an intangible asset of enormous value. A strong and recognized brand generates trust and loyalty among consumers. The ultimate goal of trademark protection is to avoid confusion among consumers. By preventing competitors from using similar or identical signs, customers can clearly distinguish the origin of products and services.